Hello, hello. Hey, Sean, how's it going?
It's going.
Welcome to our Nest Edge for June. Wow, can you believe we are already in June?
Go outside.
Yeah, we can feel it outside for sure. It's coming on fast. We named this Nest Edge webinar to differentiate this one from our other one that we do later in the month, all about education. This one is about the way we look at data, what gives us an edge over the choppiness of the markets. So please remember our disclosures that this is not advice. This is an educational webinar. Use this as education to make more informed decisions. And again, this is how we do things over at Nest. And in this game of investing, there are many, many ways to lose. There are many, many ways to win. We are just discussing our process. For those of you that have listened to our webinars before and would like to move forward with building your portfolio with us, please reach out to us at info@nestfinancial.net. We're happy to walk you through the process. I mention this every time. A statistic that we know is 152 people. We all know 152 people on average. So if in your circle of 152 people, you know someone that might want to increase their knowledge in the financial area or the financial arena, please let us know, or please forward this webinar links to them. It's our way how we introduce ourselves through our works and our conversations. This is a conversation between Sean and I, our portfolio manager, and inclusive of our audience. So if you have a question, please add it to the Q&A, and we'll be happy to address it. There'll be points, the place there where I can check on it and make sure that we get it answered for you. So let's start talking about this topic, Sean. Commodities to the moon. Of course, we picked this title because it's the meme stocks that everybody's buzzing. Sean, although we're not talking about meme stocks, and obviously the reason there because of this is there's no data, and it's mostly speculation based on short sales. However, there is data on something else, and that's inflation. So what data do we have from the governments on this, Sean?
I think it's 3 weeks ago today. The CPI number came out at 4.2% year over year inflation rate at CPI. The Bureau of Labor Statistics is the one that releases that. That's the most followed data point that people look at when it comes to U.S. inflation. So,
so
that's what
we get. Just for everybody's knowledge, this is where the government tells us, and it's called a lagging indicator. In other words, it's something that we have to wait till after it's happened for them to give us a measurement of how inflation is doing. And of course, inflation affects our dollar, and we'll talk more about that and our purchasing power. So in your newsletter, Sean, you mentioned some shocking things. Even though that the government gives us this lagging indicator, it may not be as trustworthy to bank on. Can you talk a little bit about why?
Well, I mean, the really ugly one is they're not really incentivized to show that there's inflation. A lot of government organizations have to do pay raises or increase X, Y, and Z with inflation. It's cheaper for the government to keep inflation numbers artificially low. That helps with interest rates. It helps with their public funding systems. And there's you could probably write a book on just of how the government issued CPI inflation numbers adjust things for the government. So there's some conflict of interest for sure. Is that the only reason they're doing it? No, I mean, it affects, the private market as well. But if you look at the CPI and just assume, all right, that's the gold standard, and that's all you got to do is wait till the CPI print comes out and then react. I mean, you're a dinosaur that's the asteroid's about to hit you in the head. It's a very lazy way to do it. And I understand why. That's just the way it's taught, is that the government is infallible. The people that work there are the smartest people in the room, and it's just not true.
Well, it is a lagging indicator, and so a lot of people, even in the industry, wait for that as a confirmation. Yep. We happen to always be looking ahead and forward thinking, and so that's one of the things that we have an edge on. But inflation is not the only thing that where we look at government to report on these lagging indicators, and we have to read between the lines. Sean, I remember us talking about this last year during the last administration about unemployment numbers. Is that correct?
Yep. Yeah.
Yep.
I mean, there's always a narrative that, it's not the left or the right. It's politics that it's been going on for decades that, even the Treasury and the Fed have become political entities. If there's an agenda and a goal that needs to get done, there's not one part of the government that is untouched when it comes to, the weight is coming. Recently, yep. Trump did it, Biden did it, everybody's doing it. It's just a means to an ends right now. Once Pandora's box has been opened, that's just kind of the name of the game is, you only have so many months and years to get your goals done. So you got to do what you got to do.
Right.
It's a nasty political game.
So what this means for everybody in the audience is just that we have to look much closer, even at the data, even though it's lagging. Luckily, it's not the only data that we look at. We look at a lot of other data points. But even when we look at that data, we have to read the fine print. And to this point, you said something that I thought was really fascinating, and glad that we put it on our newsletter. This was, since we know the government skews numbers politically, it's not surprising that they're, trying to make themselves look good. That's just part of the game. But when we look at this number compared to how it used to be measured, and we're talking about the inflation number, the CPI, you mentioned in your newsletter that would have reported inflation as 11%. So can you speak to that?
Yeah, the methodology that we used to use, or the BLS used to use to calculate CPI changed from, I had to look it up what it used to be called. It's the cost of goods indexed, and that changed to the cost of living, cost of goods index, and then it shifted to the cost of living index. So they dropped the goods and flipped in living. And that's when things kind of magically, you didn't see the rampant inflation numbers. It really was, the 80s, they stomped out. Inflation really didn't go away, just how they calculated it. They took off some of those, those big, high single digit, low digit numbers. Inflation was a much bigger deal, reportedly a much bigger deal in the 80s. It's still there. It doesn't take a genius to, everyone. This is the one thing that the retail investor probably could have figured out pretty easily. If you dump trillions and trillions of dollars into the economy, well, there's more dollars. That means they're worth less each.
Mm-hmm.
You don't need a PhD in economics to spell that out for you. So the methodology changed. What's in there and what's not in there. Now, I understand that they need to adjust things because it's a different world, in the last 40 years. But there's just that they put a lot of language in there with the living index. They say it's to take into account the quality of the goods changing. So like Apple comes out with a new iPad, not iPod. Those are long gone. But another great example. And there's just a lot of gray in there, and you don't really know, people in my world, we want to see the guts. We want to see exactly how, how do you come up with this number? What were the inputs? If I don't see that flow of data, I'm not going to trust you. I just inherently, I don't know where this number came from. And, I'm not saying all government agencies are bad and politically charged and everything is a smoke and mirror screen and blah, 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 blah. But if it exists at all, I'm assuming everyone's like it. It's the only kind of way that I'll look at it, I'll think about it, but then I'm also trying to, contextualize everything.
Correct. So let's talk about the importance of getting inflation right, because, the numbers, as if we look at what government puts out, may be skewed, maybe not, but for investments, let's talk about the importance of that. What does it mean for everybody that's sitting in cash? Many refer to that risk. One of the things that we teach is when we talk about risk in the markets, most people are investment risk. Most people think about market risk, up, down. But there's 5, 6, 7, there's many different kinds of risks. And one of the risks that we're talking about right now is inflationary risk, meaning because it's the slow killer, it's the one you don't see. Stock market, you can see up and down, on a daily basis, but inflation risk, you don't see it. What this means is you have $100,000 sitting in your bank today. if inflation is up, let's call it 10%, 11%, next year that $100,000 is only going to be built by $90,000 worth of stuff. So it's your money is able to purchase less. It's that purchasing power that's equally as important when you're looking at your investments. So some of the things that you pointed out in some of our client reviews that we've talked about, can you talk about a few of the commodities and what those input costs are and how high they're growing?
Your favorite part of every review. Yeah, I mean the big ones. I'll do year to date since we're 5 months and 2 weeks in, or a week and a half in. Gasoline 55%. That's really important. Oil is up 43%. The other big ones, year to date on corn is up 42%. Lumber's up just under 37%. Soybeans up 20%. The continued massive number is lithium up just over 91%. That's lithium is, no one thinks or talks about it, but it's in, if any electrical device has got some sort of battery in it, and that's lithium. Commodities as a whole, like the S&P is the largest 500 companies in the U.S. stock. There's an index for the commodities as well, the CRB index. That's up just under 26%, not even 6 months.
Right.
Which is just, and this has really been happening for the last year. This should not have, and it's been, there's been consolidation periods, but for the most part, it's just been up top, up right corner of the screen. Commodities as a whole, the joke that we like to do in reviews meetings is like, what's down? And it's, was it rubber? Where's OJ? That's the one. Orange juice is positive now. Even that's up.
So if we're looking at a basket of goods, these input costs, it does affect your dollars as clients. So no matter what the government's saying, if it's 2%, but your costs of good, your input costs are high, it's going to affect what you can purchase. And as an example, we have a client that recently retired and moved to Florida. And this is within the last 2 or 3 months. And she was looking to purchase a house. So she had to price, spec, the whole 9 yards, built. It was a new build. And we talked to her about a month ago, and she's going to wait for 6 months because no changes at all. She went back to get the process started, and the price had gone up by $40,000. So that's a huge increase in cost. And so luckily she's at a point where she can just kind of wait it out and see if prices will come back down. But it does affect everybody's pocketbook. So it's important that we get that right. All right. So one of the questions that has been asked, and we were about to address this as well, is okay. So inflation is here. How do we counteract that?
Well, the easy one is own the commodities that are rising. That's the most straightforward one. Is buy the things that are going up. If input costs are rising, buy them. If the data still supports that it's going to continue to rise, then just buy those things. But then also from an equity perspective, there's certain sectors that like it more than others. Energy, that's oil, mostly natural gas. They obviously love it. That's commodities. Materials, financials, industrials love inflation. It's great for them. Things that are not great for inflation is like tech, because they are, anything that's interest rate sensitive, high leverage companies, not crazy about inflation. If a company relies on credit to expand, it's not great. If inflation is ripping so generally correlated, and it's happening right now, treasury yields start creeping up as well, which means credit's more expensive, which in theory means it's going to be harder for these smaller companies, these techier companies are rapidly expanding. I keep picking on tech, but it's expanding companies. If credit's more expensive, it's hard for them or it's not as efficient for them to borrow and to grow. So in the equity space, they trade, flat to down. So it's just as important to know what likes inflation, but also what does not like inflation, and stay the hell out of some and get in the others from an equity perspective.
So the answer is get in there and get in there early. Now we looked at this, and I want to talk about our numbers. This is my chance to brag on the work that you've been doing for a long period of time. You started noticing this started to tick up as far as commodity prices. When was that?
June, a year ago.
June a year ago.
They started bottoming. The rate of change started slowing. I mean, they fell off a cliff with COVID, and then the rate of change from started decelerating, and then it started pivoting. A year ago.
So to completely answer that question about how do we combat it is we identify those opportunities, and that's the process that we do by looking at data on a daily basis and mapping that data. And when Sean sees that rate of change difference, it puts a checkbox like, okay, that's one data point that we need to do, and we confirm it and look at it. And then once that happens, we started adding positions to our portfolios. And so we started adding some of the things. I know that in your email newsletter, you put several of the corn and the different commodities that you've invested way back when, and those are all up. We were able to enjoy that ride up with those costs, and so that impacted the portfolios that our clients invested in. So portfolios have done really well.
Yep.
I want to just brag on one of the portfolios. Our alpha portfolio is up 51% since the January of 2020. Compare that to S&P, because S&P's also come up. S&P's up 20%, a little over 20% during that same time frame. And so far, we've got to confirm this. We're looking at our risk measured against that, because a lot of times we had treasuries when we had a lot of conservative investments early on. And so our risk profile was a lot lower than what the S&P was for a large part of the whole year. So a lot less risk, a lot more return, but that's what we get by paying attention to these changes. So commodities to the moon. Everything right now is growing. Can you tell us what you're thinking in the next 2 months, what it looks like,
nothing really changes, man, in my world. I just measure and map. I'm looking for inflection points. I'm looking for things to accelerate and decelerate. These positions that we're in, we've been in for a while, at least the core holdings. Mm-hmm. There are some new things that have come online with our exposure to Europe in the last few months, but it's probable. And if you've talked to me lately, I keep saying that word because the second half of this year, it's probable things are going to get a little choppy. And that's when the models, once the data starts, the things that we're in, once they start slowing or cooling from a rate of change basis, we'll start fading out of those positions and going into the things that have started to bottom and accelerate. I'm always trying to fade consensus. I don't ever want to be somewhere where everyone else is. If you're standing in a room with, shoulder to shoulder, it's not a good place to be, because there's usually only one or two doors, and that's when you get crushed. Mm-hmm. So I'm going to measure and map. We'll wait until the data changes. As of right now, it's all green lights. But my eye is definitely on the ball, because it's probable things are going to change between now and Christmas.
Yeah. Most of the people that are on this call or listen to the recording remember that in January, February, March, we were talking a different tune. You were moving stuff to treasury. You were moving stuff to gold. We were getting more conservative because the data, and I'm talking about 2020.
Yeah.
I saw your question in your eyes go, what? No.
But this year we were ripping. Yeah.
Yeah. 2020, I just wanted to show the difference of how portfolios do change. In 2020, before COVID, you were seeing a lot of warning signs. We didn't know that COVID was happening, but we did know that things were overheated and things just, debt was just out of control.
Disconnect. Where we were economically and equity wise was just wild. I was like, we knew a bomb was coming. I don't want to, again, we didn't call COVID. That's insane. The COVID made it worse, right. But we were set up for a massive correction. And to be honest, some of the symptoms are still there. Some of the problems are still there. So we're not out of the woods.
Yeah, we keep looking at those things. But my point is that all of our portfolios changed from a very conservative position when we thought things were just overheated and we just thought that something was coming. And we were luckily, we're in there for a few months before this happened. And what that caused is stability during the 34% drop in the market. All our clients had stability in their portfolios. And then in June, when you started seeing these changes in commodities, you started adding those positions among others, and that's what started, causing. So I'm just trying to put out there for clients to understand that it's always a few months ahead that we're looking at the data, and this is how we're able to make those positions change to prepare for that next step. And so when we're talking about things getting choppier later this year, there's a lot of reasons for it, and it just means that our portfolios will start changing a little bit to continue what we've been able to earn and get out of the way of the bus of anything that might be coming down the road.
Step 1 and 2.
One of the questions that we had from the audience was, what's the best way to invest $1 million and have over 10% return? And I want to start off by saying, I've worked in this industry for 20 plus years. And the standard answer for this was always, well, the S&P or an aggressive portfolio or duration. And I mean, there's this type of investing that we've all been taught as advisors for decades called asset allocation. It's called modern portfolio theory. And it's just what it is you diversify your portfolio and you're going to sit and wait and you look at it a year later and see how you've done, and you change out managers and you do it again. So that type of investing, which is by and large the way we used to do that. I mean, throughout my career until we built something different. But by and large, most advisors still do that, and that because that's what's being taught. In that situation, we'd have to move you to an aggressive portfolio and try to get 10 to 12%, and just kind of let time take its toll, and produce those kind of results over time. But for the most part, we always try to shoot more conservative than that. However, since we have changed our processes and we're not following modern portfolio theory anymore, we're doing data mapping, looking at macroeconomics, looking at economies across the world, and we have over 40 analysts that provide us data on a weekly basis. We're able to make moves. So that's caused our portfolios to change, and we're actually renaming the portfolios to kind of address this. But every portfolio that we have is got a target number that we're trying to reach with it. So income portfolio 6, moderate 7, growth 8, aggressive 10%. That's our target market for that. And then we had an alpha portfolio, which we talked about a little bit ago, which our target is 20% on that, and completely different than what we've done in the past. But so it is possible. It is a lot more realistic because the data, and it just makes sense. If the way in the industry people have managed using modern portfolio theory and waiting and kind of seeing what the results were, and everybody's doing that same thing, that was pre-internet. That was pre all this data that we have now. So it was a lot of this stuff, the asset allocation models and things of that nature. The internet's kind of helped us get more information, but now we have by the second information, and we can get that information from all over the world on a daily basis. And that's what we do. We've gathered information. So it enables us to manage much more efficient than some of the portfolios that have in the past. You want to add anything to that, Sean?
You killed it. How's the best way to manage it? I mean, my opinion, or not my opinion, actively, but there's lots of bad ways to be managing. Active management has a real negative stigma to it. My opinion, because a lot of people don't know what the hell they're doing. A lot of people just do technical trading. A lot of people just do fundamental trading, and almost no one does macro on overlay or does it terribly. So it's, in my opinion, active management with a macro focused understanding of where the hell are we and what's the most probable place that we're going. If you do that, you avoid a lot of the downside surprises that seem to come out of nowhere, according to Wall Street, which is a joke. Active and macro aware.
Yeah. So for clarity for the audience that's listening, macro means we're diving in really deep into the numbers. I mean, looking at sectors, we're looking at all the countries around the world. We're looking at their economies. We're finding out where they have been. We there's 4 quadrants where they can go, and we're estimating where they're going to go next. And then we look at things that do well in the quadrant that it's going to go to. So it's a lot more work that goes into it. That's the difference between passive management, which is selecting asset allocation models, selecting managers, and waiting to see how they've done. And then a year later, that's okay. I mean, you'll get good results. But we're talking the day and night difference between that and an active manager that's actually doing the work, because you can have active managers, as you've talked about, that aren't doing the work. They just sit on things. And
I'm in a study group of my peers, and I use that word very loosely because a third to half of us don't do anything. They put them in an S&P, this pie chart. They have an aggressive model. They put them in there. They charge their fee, and they never change it. Once a quarter, they'll rebalance it. And I was like, how does anyone pay you for that? I'm like, well, that's what they were taught. And they read this study that said X percentage of the time, it results in this percentage return.
Yeah. There's value there. So I don't want to take away from that, because there's still value in looking at the managers. There's still value in educating clients and helping them stay invested through various periods. So there's still value there, but not as valuable and not as nearly as much work as what we're doing through Nest, which is actively daily bringing in data from 40 analysts across the world and making those kind of moves.
You're correct. I got a little judgy there. I apologize.
Well,
part therapist, part manager.
Well, and it is interesting, because we do have get-togethers with various people in the industry, and to hear the comments that they're in disbelief. How did you guys do that? Or how are you? Having those kind of questions, and then when we talk about our process, they're like, "Wow, that's a lot of work." And sure, it is, but that's what we're here for. That's what we do. Okay, so I think that pretty much sums up our questions that we've got from the audience. I think that we've answered everything, and hopefully this we can have had a good education on inflation and how we counteracting with commodities and other types of stocks, and how commodities are actually affecting the inflation. So it's like you've got to be in there as well. How we do our process and the best way to move forward. Once again, this isn't investment advice. It's rather a conversation between how we do things between Sean and myself. And so it's education in nature only. If, however, you'd like to discuss how we do things or interested in anything else that we can do for you, please let us know. If after this you want a recording, one should come to your email box. We'll also have it on the website soon. Thank you, Sean, for your time. And thanks, everybody, for listening. Appreciate it.